So as we start out the 2026 year, I think it's important to obviously look at the global economic and also strategic outlook of the year we faced. And in earlier episodes, we looked at what 2025 really taught us. And what I want to do now is take a high level view of where we're at, then what it means for 2026, and then also a bit later in the session take a deeper dive into some market dynamics that's playing out from a emerging market and then also a developed market perspective. Leading on to what I think is a strong theme already is this moderate and resilient growth. So the world economy is set to expand at a moderate pace for 2026 with global GDP hovering roughly around the 2%, the mid 2% range. Advanced economies expected to grow by roughly 1.5, and then your emerging economies probably will average around the 4%. Again, outpacing the developed markets, but of course facing their own headwinds. Inflationary pressure projected to ease in most regions, and also allowing central banks to wind down the tightening cycle and even begin modest rate cuts or further rate cuts. However, I think what is clear is that the era of low interest rate is over, and borrowing costs will remain higher than the historical norms that have played out since the 2010s, which will need to be considered. I think a second broad theme that needs to be looked at is the shifting policy and geopolitical landscape, and this is going to clearly be ongoing. Policymakers in 2026 confront, I think, a very complex background. In US, Europe, monetary policy is expected to remain data dependent, but with an eye towards sustaining growth as inflation is normalizing around 2%. Fiscal policy is divergent, so some governments are loosening the purse strings to support growth. We're seeing this in Germany, and others, the UK, face constraining budgets and must balance stimulus with debt sustainability. On the geopolitics, will heavily influence the economics, so trade tensions and economic fragmentation, of course, exasperated by renewed tariff wars, and geopolitical risk are reshaping tensions, um, and yeah, these are reshaping supply chains and damaging global trade momentum, and many emerging economies are prioritizing domestic stability and regional partnerships to navigate the US-China decoupling and obviously the other international strains. The third broad theme around corporate transformation, and this also, those of you who have listened to some of the earlier videos that I've shared would also pick this up. We've seen renewed, and this will sustain into 2026, focus on transformative strategic priorities. Artificial intelligence and digitalization continue to be top of the agenda, not only as opportunities for productivity and new business models, but also as areas of caution amid still quite frothy valuations. But after a wave of AI adoption, CEOs are now pursuing to convert AI pilots into return on investment. So concentrating on high impact use cases and guarding against potential tech bubble, which again we've seen before. That's potentially another comment to look at a bit later around what is playing out from a valuation perspective in the AI world or in the software world, but we'll park that for now. Sustainability and ESG imperatives remain high and critical. Companies are working to decarbonize and building climate resilience in their operations. And even as policy support varies policy support also varies by region. So the cost of inaction and on climate is also rising, with estimates that severe weather and net zero transitions could put significant corporate earnings at risk over the next decade. Of course, at the same time, firms are seeing sustainability as a source of innovation and increased stakeholder trust, aligning climate goals with long-term value creation. Capital deployment and efficiency is under the microscope in a higher cost of capital environment. Having endured inflation and supply shocks, companies are adopting a much more disciplined cost management program to fund growth initiatives. So for example, reinvesting cost savings into your digital innovation and AI to gain competitive advantage. And then, of course, also supply chain resilience has become a permanent strategic theme, from semiconductors shortages to geopolitical trade barriers. Executives are diversifying supplier bases, nearshoring or onshoring critical production, and investing in supply chain visibility and agility to withstand disruption. Another theme, deal making and investment outlook. Again, just broadly, we are going to look at this in a bit more detail. But I think despite the recent volatility, the outlook for mergers, acquisitions, private equity investment remains optimistic, cautiously optimistic, probably in most views. Prior to 2025, we saw a resurgence in large M&A transactions. We saw global deal value jump, totaling 1.6, 1.8 trillion, which is about a 45% jump year on year, amid still with these tariff conflicts. So this momentum is expected to carry into 2026 as well. So supported by, I think, very relatively sturdy macro fundamentals, and of course an abundance of investor capital. So something played out actually also in 2025. From a sector perspective, for deals, technology, especially AI-driven businesses, healthcare, biotech, and energy transition assets remain a key focus. In 2025, over 1/5 of mega deals had an AI theme, and a trend likely to continue as companies seek to acquire digital capabilities. We look at the private equity firms, again, sitting on record dry powder, and really stepping up activities. So sponsor-backed deals, volume and value rose sharply through 2025, and your PE buyers are anticipating to remain active in 2026 as financing conditions continue to improve, although gradually. In the VC space, investment is finding its footing again after the pullback we saw in 2022, 23, and a little bit in 2024. But stabilizing market conditions, lower interest rates, and also the excitement around disruption, research and development, specifically around AI, is supportive. About 65% of global VC deals in 2025 was AI-related companies. So underscoring that the technology sector will be a magnet for funding. But of course, deal makers will need to navigate structural challenges. The higher regulatory scrutiny on large transactions, antitrust and national security reviews are more demanding than ever. Then again, there's also been the pullback on some antitrust legislation in the US. Geopolitical consideration in cross-border deals, again, a key driver for what we saw happening in M&A, and a much more selective investment in investor sentiment, looking for quality assets and clear value creation plans. Now, all of this requires really strong leadership. So corporate executives must guide their organizations through a very fragmented and uncertain global environment, and really this calls for adaptive and principled leadership. So CEOs and boards and executives in 2026 are increasingly expected to act as chief strategists and unifiers, steering their companies with agility while keeping their workforce engaged and cohesive. Leading companies are fortifying risk management and governance framework. So, for example, integrating political risk intelligence into strategic planning, even establishing dedicated teams to monitor evolving sanctions, tariffs, and political flashpoints. Now, in the boardroom, there's emphasis on balancing stakeholder expectations, delivering financial performance amid headwinds, upholding strong governance and ethical standards, and demonstrating social responsibility. Internally, the challenge of these polarizing social climates has not spared the workplace. So, forward-thinking CEOs are championing inclusive cultural and civil discourse, positioning their firms as havens of productive collaboration, regardless of external turmoil. Now, in practice, this means that proactively addressing divisive issues, reinforcing a shared sense of purpose, and then modeling value-based decision making at the top is needed. Um, and what we're going to look at in the next few sessions also is taking a deeper dive into some of these areas. So looking at a deeper analysis of economic forecasts, some key strategic business deals or business themes, deal making trends, and then also following on the 2025 learnings to look at some leadership guidance of how best to position yourself for 2025. Now, it's important then with this context of these broad themes when we start looking at the macro trends that will play out for the year. So macro trends and policy expectations for 2026. I think starting off again, maybe just delving deeper, but still with a broad theme. I think on balance, global economic growth in 2026 is expected to be positive, as noted, but slightly lower than what we saw in 2025. And I think again, a synchronized global recessions looks unlikely given the resilient consumption and the absence of a financial bubble in 2025. However, I think growth will still be uneven across the regions. The macro environment is definitely one of transition from high inflation to moderate inflation, from moderate tightening to cautious easing, and from hyper globalization to a more fragmented trade system. So executives should prepare for this new normal. And again, we likely have had a few new normals, but this new normal of moderate growth and higher complexity. Encouragingly, if global GDP and corporate profits do expand as forecasted, it sets a generally a supportive backdrop for business investment and decision making in 2026. So I think here too, the prudent leader will also keep an eye on the downside risk, ongoing political tensions, potential financial market volatility, and then the ever-present threat of unexpected shocks by staying agile and informed, and that companies can navigate the macro environment and even capitalize on regional growth divergence. Now, this being said, I think it's important to take a deeper look at what development markets present, but also then what the emerging markets present, seeing that we've got already a divergence in growth, and the risk and opportunities definitely look different because of that. So taking a bit of a deeper dive into the developed markets, and we'll start off with the US. The US economy is really entering 2026 on a relatively solid footing, but is expected to downshift to a more sustainable growth rate. So forecasts indicate US real GDP growth of roughly 1.8% for 2026, which is a step down to the prior year, but still marks the US as a growth leader among the advanced economies. And this resilience is underpinned by robust consumer spending and business investment in R&D, disruptive technologies, and so just generally in investing in technologies. Strong household consumption and really a booming capital outlays on AI and automation has helped offset many of the headwinds, such as high interest rates. If we look at Moody's Analytics, one of their reports noted that was surprised by the surprising strength of the US economy, really supported by these factors that led to this increase in them increasing their outlook, the 2025 and 2026 outlook upwards. but American firms are also experiencing a cooling in job creation, income growth. So suggesting some late cycle moderation is also at play. If we turn, still focusing on the US, and if we turn to the policy front, US inflation is expected to continue its decent its descent forward. So Federal Reserve's 2% target through 2026, after the price shocks of the early 2020s, and this disinflation trend, if realized, gives the Fed room to maintain and accommodate. But again, a stark change from the aggressive tightening seen in 2022 and 2023. So, in fact, the Fed began cutting rates in 2024. So we saw the rate cuts in 2025, and it's poised for, I think, some further adjustments on rates late in the year, late in the 2026 year, if inflation and growth obviously behave as expected. I think central banks, the rhetoric emphasizes this cautious optimism. Policymakers see inflation moderating and labor market stabilizing, but of course they remain vigilant. So the US political backdrop under the current administration could introduce pressure for easier policies. The Fed's independence and leadership, with the Fed chair's term ending in 2026, are factors being watched by the market very, very closely. So overall, the monetary policy in developed markets is shifting from break to neutral, and major central banks, including the Fed and the European central banks, are likely to end their hiking cycle and carefully start lowering interest rates further, effectively lifting the constraints on growth imposed by the higher borrowing costs historically. But again, I think a theme that's come through strongly is that it's been made clear that the pre-2019 era of near zero rates will likely never return. Rates will stabilize at levels that are lower, but not ultra loose and ultra low, reflecting this persistent underlying inflationary pressure, which is driven by wages, but also driven by the cost of deglobalization, the onshoring and the nearshoring, and certain other resilience built into the supply chains. And this needs to be included to rebuild these policy buffers. If we shift to Europe, the outlook there is one of subpar growth, but again, gradual improvement in domestic demand. The Eurozone is projected to grow in the order of about 1%. Again, modestly then weaker than 2025, but you can see also way under the US. High energy costs in the wake of recent conflicts, endemic production growth, and tightening monetary conditions, with the European Central Bank earlier rate hikes are also weighing on this recovery. However, there's obviously bright spots. Fiscal policy in key economies is turning supportive. This should bolster spending. Germany, for example, has shifted to a more expansive fiscal stance, really providing stimulus that supports the Eurozone's domestic demand entering 2026. Labor markets in Europe have also shown resilience. Unemployment remains relatively low, and as inflation comes down, real incomes are expected to slowly start improving, aiding consumption. So year two, the Eurozone inflation, which spiked into the double digits in 2022, has fallen back to closer targets. And year two, we have sort of consensus around the forecast we see in Euro area, where CPI in 2026 of 2.5%, enabling the ECB to halt any hikes, and look at a cycle of stable and potentially and further reducing rates. So by 2026 and for 2026, we can start considering rate cuts coming through. Although this will likely be Europe's stickier core inflation and past currency weakness will affect this. The UK faces very similar tepid growth path after narrowly avoiding a recession in 2024, 2025. Looking to forecast to expand at about 1.2%. slightly lower than previous estimates. Easing inflation, falling interest rates, in theory, should also spur on activity. Year two, the OECD projects UK inflation to slow from around 3.5 and stabilize for 2026 at around 2.5. So a welcome relief for households and their budgets. But even so, the British economy contends with structural drags, so sluggish productivity, weak working age, population growth remain hurdles to any real growth acceleration. So UK fiscal policy under the current government is somewhat constrained. So while 2025 budget included increased spending, it was paired with tax rises and the country's high debt and deficit limit room for maneuvering. So looking at Europe, the outlook is slow growth and continued transformation driven by the green transition and supply chain reorganization rather than a sharp upswing. And the macro backdrop, modest GDP gains, declining inflation, but it's good enough to stabilize business conditions. But European corporates will still need to drive competitiveness in low growth home markets. If we look at developed Asia and Japan, year two, I think slightly firmer growth compared to recent years. Domestic demand has been recovering as the pandemic pressures has waned over the last 5 years, and there's also signs then of wage growth that could support consumption. However, Japan's exports also face headwinds from a slower China and global trade friction. Again, after I think ultra years of ultra ease policies, the Bank of Japan has started adjusting the yield curve, and this again may start having an impact, especially if the yen association becomes a policy goal. The currency forecasts see the yen strengthening in 2026 as the US rates fall relative to that of Japan, really ending a long period of yen weakness. So this shift, along with Bank of Japan's governor, makes Japan's policy stance and a slight outlier, and one moving towards normalization, while others are easing. And again, this could also impact capital flows to the region. And of course, another developed market in the Asian economies is South Korea and Australia, and are all in middle positions. They're experiencing inflation. There's still pressure on rates, although also looking to relax. So again, this is moving to also a more favorable environment with if more rates cuts come through, cautiously supporting growth. And it's important still under these to also keep an eye on currency stability and also capital outflows as global rates change. Now, of course, with this context still focused on the developed markets, there's certain key risks playing out and affecting that's going to affect the 2026 year. And this is, again, maybe some that has come through and might some be quite obvious because we're all living through this. But our overarching theme is that policy uncertainty remains high, despite these baseline forecasts. The immediate inflation crisis has abated, but central banks are very wary of declaring victory too soon, and they still have to navigate potential shocks. So, for example, oil spike or a new supply chain disruptions could flare up inflation again, complicating rate policy. So your fiscal policy makers in the US and Europe are also facing potential political shifts, and that could also trigger budgets, taxes, and regulations with relatively little warning. Advanced economies are grappling with second order effects from the geopolitical conflict, war in Ukraine. The Russia-Ukraine conflict, for instance, forced Europe to accelerate energy diversification and raise defense spending. The US-China strategic competition is leading to export controls and friendshoring initiatives, and that restructure certain industries like the semiconductor industry is happening. And these trends contribute to what executives described as a fragmented global environment where geopolitical events more than traditional economic cycles drives outcomes. the World Economic Forum actually made a very good, in one of their reports, made a very good quote and noted that national security-driven trade policies and geopolitical volatility are now bigger drivers of inflation and supply disruption than classic economic cycles. So very interesting times. And yet too, corporations in developed markets has to plan for an environment in which government policy, so tariff sanctions, industrial policies can change the business landscape overnight. And the upside is that in the absence of major shocks, the combination of low inflation, peak interest rates, reducing rates, and still positive growth, this could create a reasonably favorable climate for corporate performance. Now, it's also important to focus on the emerging markets where we see a lot of resilience amid various divergent challenges. So emerging and developed economies as a group, I think, are poised. Emerging and developing economies are poised as a group to grow faster than your advanced economies, which again is a trend we've seen play out the last few years. Roughly 4% growth of your emerging markets versus that of about 1.5% of the advanced economies. However, within emerging markets, there's a wide variation and mix of opportunities and risk, depending on which jurisdiction you actually looking at and looking to operate in. Now, if we start with China, the world's second largest economy, has been facing a delicate balancing act and is facing a delicate balancing act for 2026. We saw a great bounce back over the last 5 years post pandemic, and then a bout of weakness in its property and export sectors. So year two, China's growth is entering a slower trajectory. Moody's put out guidance of about 4.5% for 2026, which is down from 5% in 2025, and on a path for 2027 to grow at about 4.2%, far lower than the figures we've seen obviously historically. So not necessarily a new trend, but still much lower than the recovery we did see. And China is counting on domestic demand to do the heavy lifting, as external demand is faltering. And again, indeed, we see China's export strength, which propped up growth in 2025, is likely to lose momentum in 2026, putting much more onus on household consumption and services to drive the economy. And the government has rolled out pro-consumption and pro-business stimuli, such as rate cut and targeted credit easing, but the impact is tempered by structural drag. So high household savings, and aging population, and ongoing strain in the labor market means consumer spending will only gradually improve. China also continues to grapple with real domestic downturn and local government debt stress, which weigh on confidence. So China's growth is slowing to a multi-decade low, and this has global implications for commodities, commodity demand, supply chains, and investment flows as well. And policymakers in China are likely to maintain accommodative monetary settings and some fiscal support in 2026, but also pursuing longer term reforms to rebalance the economy. So boosting high tech manufacturing, reducing resilience on property investment. For multinational businesses, of course, China remains a huge market, but it's one with more subdued growth and higher policy unpredictability. And again, of course, including the US China and trade and technology issues continue to simmer, and how that plays out will be crucial. India and Southeast Asia has become a huge driver of emerging market growth. It's a major emerging market performer. Indian economy is projected to grow on about 6% plus in 2026. Saw roughly expansion of about 7% in 2025. So this robust pace makes India one of the fastest growing G20 economies. And here too, key drivers is strong infrastructure investment by government, government, resilient domestic consumption, and increased diversification of exports, with China carving out a large share of global manufacturing trade. And indeed, even as global trade patterns shift, China has managed to redirect export to new markets. So, for example, after the US imposed steep tariffs on Indian goods in 2025, India still saw overall export volumes grow by finding alternative buyers. And this agility, as part of its broader trend of the southern economic ties, really strengthening. However, of course, India is also facing challenges. Private sector capital expenditure has been sluggish. Many Indian corporates remain cautious on big projects despite favorable macro indicators. Inflation has been volatile due to food prices, but the outlook is relatively benign, with CPI expected to be around the mid 3% in 2026, giving the Reserve Bank of India room to possibly ease policy further. Elsewhere in Asia, smaller economies, Pakistan, Bangladesh, etc., also growing, but contending with high debt and inflation. And again, this is, the IMF has noted this a few times. This is often needed to support to stabilize. Staying focused on emerging Asia, your Asian growth in 2026 is also likely to be quite solid, not spectacular. Countries like Indonesia, Vietnam, Philippines could see growth of 4 to 6%, fueled by youthful demographic, FDI inflows, some benefit from the China plus one supply chain shift, and obviously domestic consumption. Export orientated Asian economies like Malaysia and Thailand will see the pinch of the softer Chinese demand, electronic cycle downturn, but intra-Asian trade and fiscal stimulus can provide some set off. So notably, a dynamic Asia Pacific emerging economy overall is forecast to experience a growth slowdown in 2026 compared to 2025, but it's partially reflective of the unwinding of this one-time boost from exporters rushing shipments ahead of the new tariffs in 2025. So in other words, some export growth in 2025 was front-loaded due to the trade policy uncertainty, and 2026 saw you will see this being paid back or paid back. However, many Asian emerging market central banks have raised rates in tandem with the Fed, and then also we'll see a pivot in the rate cuts in 2026 and 2025 and 2026 coming through also as that stabilized and as inflation is expecting to be moderate. And again, so bar any renewed commodity shocks, we should see some good stability there. Latin America, again, modest growth, improved stability. Brazil, for instance, projected to have growth around 2% through 2026, not high by emerging market standards, but relatively stable outlook given the past volatility. And Brazil's story includes easing inflation and interest rates, again, after very, very high inflation in 2022, 2023. And also then a policy mix that allows more investment. So political developments, new government in Brazil focusing on social programs and infrastructure could influence policy and investor sentiment. Mexico may benefit from nearshoring trends as the US companies invest in supply chain proximity, providing upside growth as well. Yet it must still navigate the US trade policy and changes and domestic security concerns. But overall, Latin America faces this 3% trap, sitting in this 2 to 3% growth, and a few economies are able to break out of that and have sustainable higher growth due to productivity constraints and fiscal limitations. But a big positive factor is the commodity outlook. Prices for oil, metals, agricultural commodities are off their peaks, but still relatively elevated, supporting export revenues for resource-rich countries. But of course, commodity dependence is a double-edged sword. A sharper slowdown in China or global demand could hurt your Latin export, and commodity-driven inflation spikes remain a risk. Turning to Middle East and Africa, if you're looking at Middle East and North America first, Growth in oil exporting Gulf states is expected to be moderate as OPEC um, uh, cuts or increases production cost, and oil prices fluctuate, continue to shape income. High oil prices in early 2025 boosted budgets, but many forecasting see oil prices trading at within a moderate band. So Saudi Arabia and others are also pushing the diversification agenda, which could generate non-oil revenue and growth via government-funded projects. But meanwhile, countries like Egypt face serious adjustments, high inflation, the need for currency reform, and also IMF support. So here too, the geopolitical tensions in the Middle East, including the unresolved conflicts, add an extra layer of uncertainty that it could impact investment and also tourism. If we turn to sub-Saharan Africa, the outlook shows gradual improvement. The region is projected to also grow at about 4% for 2026. This is up from 4.1 in 2025 and up from 3.5 in 2024. So while the pace is below the rate needed to significantly raise living standards, given the high population growth in Africa and this hopefully rising middle class, but it's a very young population in Africa, does signal resilience. The outlook for sub-Saharan Africa is showing resilience despite a very challenging environment, with growth holding steady and even picking up slightly thanks to macroeconomic stabilizing and reform efforts in key economies. Countries that has endured severe inflation and debt pressure like Ghana and Zambia have taken steps towards stabilizing, and higher commodity prices for some exports. Nigeria and Angola talk about critical minerals in most, and oil in Nigeria and Angola are providing very strong tailwinds. Also, something that has lifted these economies to rebound post the pandemic. But many nations are still still face pronounced vulnerabilities. Many nations are still dealing with tight or highly high cost external financing conditions. So global interest rates may be at their peak and may be reducing, but investors' risk appetite remains selective, and several sovereigns are effectively shut out of capital markets. Debt sustainability is a major concern. Overlapping fiscal and external debt vulnerabilities means countries must improve domestic revenue collection and debt management to reduce that risk. Then, of course, climate-related disasters remains an acute challenge in Africa. The emerging markets, specific in Africa, it was noted by Moody's, tend to be more exposed to extreme weather events, but have fewer resources for the adaptation and resilience. So droughts, floods, and other natural disasters in 2025 affected agricultural output and infrastructure development in Africa. So as such, events could reoccur in 2026, straining household and government finances. That said, on the positive side, foreign capital flows to emerging markets could strengthen in 2026. Also, in Africa's case, with the global rates coming down, and year two, I think it was Moody's that observed that lower US rates and weaker dollar and investors' desire to diversify away from the US are likely to spur capital flows to emerging markets. Again, in Africa, this might translate to growth in local currency bond markets, renewed interest in frontier market investment, though it can still be volatile, and especially around elections and political surprises. So if we look at your emerging markets, I think there are a few cross-cutting themes that come to the fore that we need to look at. So almost emerging market policy and strategic factors shaping the market for 2026. So still focus on emerging markets, but looking at some cross-cutting themes that should be kept in mind is this geopolitical alignment and non-alignment movement. So many emerging economies are carefully navigating great power tensions. So rather than choosing sides, they're focusing on domestic priorities and forming pragmatic partnerships. So, for instance, you've got the global South is asserting itself in a term used to describe a group of sort of low and middle income countries from from the Southeast Asia, Africa, and Latin America that are um, collectively hold growing economic clout. And these countries often aim to stay non-aligned, trading more with each other and capitalizing on being swing states in the global economy that everyone wants to do business with. And we see this as the rise of the South to South trade and investment flows happening. I mean, in 2026, emerging market governments will like to continue strengthening those regional blocks and the South to South cooperative, such as the Africa Continental Free Trade Area. Or new BRICS initiatives can serve as a buffer against the fragmented global system. Then, of course, you've got domestic political transitions. Of a number of emerging markets have significant elections and political transitions, 2025 and 2026, which again could lead to shifts. There's a number of elections that bring the potential for policy changes to the fore. Coming out of 2025 and then going into 2026. And the social pressure may push governments to prioritize short-term stability over long-term reforms. And here too, I think from an executive perspective, executives should monitor these political cycles closely because they will affect regulations, state intervention in the economy, or the openness to foreign investment. So if a major EM swings from a market-friendly regime to a populist one, or vice versa, that could have a very big impact on the business climate. Of course, we also have to focus on monetary policy, and we see monetary policy easing and your foreign exchange dynamics as inflation stabilizes and abates. Many emerging market central banks are set to cut rates further. Brazilian central bank, for instance, started cutting cycle in 2024. We saw Chile, we saw India following, and this will continue in 2026. So easier monetary policy in emerging markets should also support growth. But of course, there's a catch. If the US Fed eases as well, the interest rate differential may not be as dramatic. So EM currencies might remain relatively stable or even strengthen versus the dollar. In fact, the US dollar is expected to weaken somewhat further in 2026, which again is we saw in recent times also happening, reflecting the narrowing US rate advantage and the large US external imbalance. So a softer dollar typically relieves pressure on emerging market currencies and dollar-denominated debt. But many EM's currencies are forecasted then to appreciate against the dollar in 2026, which would be very welcome development for those battling import inflation. Japanese yen, European currencies might also lead these gains, but again, emerging Asia and commodity currencies could also firm up. Nonetheless, currency risk hasn't vanished. Countries with weak fundamentals could still see bouts of capital flights. So corporate planners in emerging markets should continue to stress test their balance sheets for FX volatility. We touched on trade policy and tariffs already, but maybe as a summary or maybe as further input from emerging market perspective, I think one of the biggest uncertainties in the future of global trade policy remains the return of the US protectionism, so tariffs against China and some goods on India, and the retaliation measures by nations threaten the international business landscape. For emerging markets reliant on exports, that's a double-edged sword. Someone like Vietnam, Mexico may gain from trade diversion, so companies seeking tariff-free origins, while others lose market access. A key example in the US China tariff confrontation is the escalation. If it escalates further or broadens, your Asian manufacturing hubs will need to adjust very quickly, and this is where there's potential for new trade frictions. For instance, carbon tax or carbon border taxes that could hit emerging market exporters with very high emissions or technology export controls. So again, EM policymakers in 2026 are trying to bolster competitiveness by striking trade agreements among themselves and investing in capacity, but they must also be agile to respond to these trade barriers. In summary, emerging markets in 2026, I think, offers a relatively a story of relative dynamism and opportunity, higher growth in developed markets, tempered by pockets of fragility and uncertainty. Many of the emerging markets have demonstrated resilience through prudent policy and adaptation. And again, so much so that Moody's expects emerging market macroeconomic and credit conditions to remain resilient in 2026 and for much of the year. But of course, this cannot be taken for granted. Overlapping challenges from debt to climate to geopolitics persists. So corporate executives with interest in emerging markets or based in emerging markets should be attuned to the country-specific conditions. The dividend of being in this fast-growing market can be substantial, but the outcomes, the range of outcomes can be wide. So it'll be crucial to monitor policy changes, especially around elections and geopolitical events, and have contingency plans in place for scenarios like renewed financial stress or supply chain disruptions. Hope this insight and then this view for setting the background for coming out of 2025 and what 2026 needs to be thought about and needs to be considered is helpful. And looking forward to exploring some of these topics further with you. In our next session, what I will look at is, based on this, some major themes that are emerging that's affecting corporate strategy, or that the executive should think about, that's affecting our corporate strategy and transformation for 2026 ahead. So we'll delve into a bit of detail about what should companies now do with this background of understanding what the 2026 year economic environment at this stage will hold. And it's something we'll pick up on probably on a quarterly basis, but as we also start reflecting back on what is projected and what has actually transpired and how we can pivot and adjust to that. But thank you for listening, and we'll talk to you soon in the next